Forex trading for beginners, full training the way I would have wanted it, knowing what I know now with a smart money and institutional twist. Let's get straight into it. What's good, family? Welcome back to another video. Today's video is going to be a full breakdown of the Forex basics the way I would have wanted it, knowing what I know now with the way I trade. I get tons of messages nearly every single day regarding people who are just getting into Forex. They want some kind of beginner's course. I've got you guys. This is going to be completely for beginners. It's going to be a full training. It could take a couple of hours. I'm not too sure, but guys, you need to stick around for the whole video, especially if you're new, because there's going to be some nuggets that you guys don't want to miss. So let's get straight into it. So before we get into anything, guys, we need to break down what the Forex market is. So the Forex market is a financial market where every single currency in the world is traded. We're all participants of this, even when we go on holiday and we need to exchange let's just say you're from the UK, you want to exchange your pound sterling and you're going to America, so you want to exchange it for the dollar. Without you even knowing, you've participated in the foreign exchange market. So it's a massive financial market. $6 to $7 trillion is traded on average in the foreign exchange market as well. So in other words, it's quite liquid. There's tons of money in the foreign exchange market. So who are the players in the financial market? So some of the players in the financial market are the central bank. So basically your country's bank. Whatever your country's bank, so in the UK it will be the Bank of England, in the US it will be the Fed, and in Europe it will be the central banks. We have large funds, so large institutions that have tons of money and they can literally just go in and move the market. And then we also have the retailers who basically can do nothing, but they are another player within the financial market. And when I say they can't do nothing, I mean retail traders can't move the market. Retail traders are like people like you and I. We don't have enough funds to even think about moving the market even 1 inch. So one more time, we have the banks, we have large funds, and we have retail traders as well. And there's going to be other players within those as well, but we don't need to worry about them for now. So how does one profit in the foreign exchange market? So keeping it very simple, this is going to be a basic training, full training for beginners. And so we're going to be keeping it very simple, very light, but it's going to be jam-packed with tons of information. So quickly, just to break down what currency looks like, you can literally see here, it says GBP USD. Where it says GBP, that's normally the base currency. And where you see USD, that's normally the quote currency. So you're basically saying, how much USD can I get for 1 GBP or for £1 sterling? Or in other words, how much dollars can I get for 1 sterling? And so when you look all the way to the right here, you see where it says 1.3424. That's just literally saying that for every single pound, you can get $1.34. That's exactly what you're saying. So for every pound, you can get $1.34. If GBP USD is rising, so let's just say if you look at the chart and the chart is rising, it basically means that the pound is stronger than the dollar at that moment in time. And vice versa, if GBP USD is dropping, it basically just means that the pound is weaker than the dollar at that moment in time. And this is as basic as it's going to get. This is the very most basic part of this whole thing. We just need to cover this so you guys get a good understanding of what Forex is about. So there needs to be a way that you can measure whether price is increasing or price is decreasing. So just to break it down, let's just say in a 100-meter sprint, how you measure 100 meters is in meters. In the foreign exchange market, how you measure movement is in pips. So for example, if GBP USD went from 1.3410 to 1.3420, you see this number here, it says 1.34, let's just round it up to 20, and let's just say price went up to 1.3430, that means GBP USD has moved up 10 pips. If it had gone down from 1.3420 to 1.3410, it's moved down 10 pips. So now when it comes to getting involved with the foreign exchange market, you need to understand a few things. So there's going to be a broker platform, there's going to be a trading platform, and there's going to be a platform where you do your analysis on. So we're going to break that down for you right now. So a broker is similar to a bank. You know, with a bank, you put your money into a bank account, and what the banks will normally do is the banks will go forth and trade your money. They'll loan out your money with interest on top. They'll trade your money into different financial assets. And then what they will do is at the end of the financial year, they'll give you absolutely nothing, like 0.01, maybe 2%, which is just peanuts. It's nothing. So that's what the bank will do. But when you put your money into a broker account, you literally can trade that money for yourself. So with the banks, they traded your money and gave you nothing. But with a broker account, you can trade that money and you can get a return on whatever financial asset that you're looking to trade in. So that's the broker platform. There's also going to be a platform where you do your analysis. So for example, I do all my analysis on TradingView. Right here at the top left hand corner, you can see this is the currency pair that you're trading. And right beside it, if I just click into that, you can see that there's various different time charts. So we have a monthly time frame, a weekly time frame, a daily time frame, and so on and so forth, as you can see. So basically, you see I'm on a daily time frame. It just literally means that every single candlestick that formed, every single one of these candlesticks, it took a whole day to form. It took a whole day. That's what it did. If I went down into the let's say into the 30-minute time frame, and let me just quickly zoom out. Everything can't fit into the screen just like I did in the daily time frame. But the daily time frame, you can get in a lot more data. With the lower time frames, you can't get in as much data. On the 30-minute time frame now, every single one of these candlesticks, let me just zoom in a bit more, took 30 minutes to form. But the only difference is that on the daily time frame, they take a whole day to form. On a 30-minute time frame, they take 30 minutes to form. So we talked about the broker, we talked about the platform where you're going to be doing your analysis on. Some people use other platforms. I use TradingView. The third place is actually the trading platform itself. There's various different trading platforms out there. You would obviously have to pick the trading platform that you like and that suits you. I use MetaTrader 4, or abbreviated as MT4. And so you can download that from the App Store, and that app will actually allow you to trade your money. But as you guys know, I want you guys doing this in your demo account. Okay, so you're not going to be trading live funds. You're going to be back testing and learning this information before you even think about trading live. Now we're moving on to some more juicy bits. We're going to be talking about the market conditions. So there are 3 types of market conditions out there. There is a bullish market when price is rising. There is a bearish market when price is dropping. And there is consolidation, and that's where price is moving sideways. Some people call it a ranging market as well. Okay, so I've got my trusty whiteboard, or you can call it a blackboard, whatever you want to call it right now. And I'm going to show you guys what I mean by a bullish market, a bearish market, and a market that is going sideways. So a bullish market is a market that's making higher highs and higher lows. So right here, you can see price is making higher highs and higher lows, like that, higher highs and higher lows. So in other words, this is a bullish market. It's not going to look as clean as this. There's going to be different kind of trends happening within this whole push up. Basically, but this is just all based off a daily time frame. And so what's happening is price is making higher highs and higher lows. And what I mean by that is when price pushes up, but it retraces back down, also known as a pullback, it doesn't beat this low over here. Instead of beating the low, it rallies up to run past this high. Prices produced a higher low and a higher high. And you can see it again, once again, price when it trades lower, it doesn't beat this low. Instead, it creates another low and it beats this high. So in other words, what I'm trying to say is price is making higher highs and higher lows. And whenever you see price making higher highs and higher lows, price is in a bullish market. You want to be on the buy side, or technically there's nothing wrong with being in a sell, but as long as you know price is retracing, you shouldn't be looking to hold this trade for a very long time, because they will stop you out. They will trade back up to run these highs and to take the stop losses that are resting above here. But we're going to be moving on to that a little bit later on. Like I said, we've got the institutional smart money twist to this. This is completely different from every single beginner forex trading video you have ever seen. We're going to be chopping this up. We're going to be giving you the meat on top of the bones right here. Cool. Now, when price is making lower lows and lower highs like this, lower lows and lower highs, this is known as a bearish market. The market is dropping. The market is falling. The market is being sold off right now. Look at these highs over here. Look at these highs. Price is not trading above these highs, as you can see. You can see these highs aren't being traded above or traded through. What is being traded through? These lows. When you see highs being respected and lows being violated, you are in a downtrend market. And I'm going to show you examples of these on the charts as well, so you guys can see what it looks like. Because like I said, it's not as clean as this. You're going to get different kind of trends in here depending on the time frame you're looking at. What you want to do is you want to primarily be focused on trying to sell the market whenever it retraces. If you are looking to be a buyer when price is retracing or when price is pulling back, you just need to know that this is not going to be long term. It shouldn't be long term, it should be short term, because the ultimate trend of the market is down. And I've just drawn up the third condition of the market, which is a consolidation market. And this is basically when price is moving sideways. So as you saw in the previous two diagrams, price was making higher highs and higher lows. That was bullish. The second diagram I showed you was price was making lower lows and lower highs. That was bearish. And now this market is, as you can see, is not going anywhere. In other words, price is going sideways, it's ranging, it's not going up and it's not going down. And so this is the market where generally people tend to avoid. The reason being is because you will be stopped out multiple times, because you'll be thinking it's a buy, you'll be thinking it's a sell at certain points, and then if you're not quick to take your profit, price will normally come back to hit your stop loss. This kind of market condition generally isn't the market you want to be trading unless you're well advanced in trading consolidation. Let's just say you did go into a sell from this level, you would have been thinking it's a sell, and then price came out to hit your stop loss right here. You would have been taken out. Then you might have thought, then it must be a buy. Then surely when it gets back down to this level, I'm going to be in for a buy, and then you get taken out down here. If you don't know how to trade a market where price is ranging, then you should be staying out. There are advanced ways of trading consolidation and all of that as well, but this is not what this Forex beginner full training is about. So consolidation markets, stay out of it unless you know exactly what you're doing. So in an uptrend or in a bullish market where price is making higher highs and higher lows, there's a few more things you need to understand about what they're doing. I'd never found out this in the very beginning, and if I had found out this, the whole game would have changed for me. It would have been so much better from the very start. So basically, when price pushes up and retraces and then breaks a high again, what is price doing? Price, first of all, is retracing. It will normally retrace to a specific point for some kind of mitigation play or some kind of imbalance fill. And we're going to be breaking that down a bit further on down the line as well. But then generally what happens is when price starts to retrace, after it's done mitigating what it wants to mitigate, it then seeks buy side liquidity. And what liquidity basically means is liquidity is just money in the market, where the money is in the market. I do have a full 3-part series on liquidity. I'm going to attach that to the card so you guys can chop that up after you've watched this beginner video. That video will complement this one a lot. What I mean by liquidity is that there's going to be stop losses up here. And so the kind of stop losses that are going to be up here are, first of all, people that are doing breakout buying. What that basically is, people that like doing some kind of breakout strategy. So if price was to break above this high over here, what they're looking to do is they're looking to be buyers. Okay, they're looking to be buyers and they don't want to take price up. You know, they want to take price up. That's what they're looking to do. They're going to be at this level in the form of buy stops. They're going to have a buy stop here and price will break out. There's going to be people that are looking to protect their money. So in other words, what's happening is there's going to be people selling at this level, and when they want to protect themselves, they'll put a buy stop on the other side. Just in case price goes against them, they're protecting their money. They'll be going the other way of their trade, but they wouldn't have lost any money because they're also buying the other side. And then there's also going to be retail traders who put stop losses up here. So for whatever reason, they're going to be thinking this is a very strong zone. Once they get their rejection sign, they're going to jump in for sales and they're going to put their stop loss, their money up here. That's what they're going to do. They're going to put on their money in this level over here. So what I'm trying to say is there is tons of money in this area here. And so what after price has mitigated what they need to mitigate, we're going to come on to mitigation and drawdown and all of that a bit later on. What the banks will do, the banks will be in drawdown in this level over here. Price will pull back down into this level. So I didn't really do it properly. Let's just do that. Into this level over here, mitigate. So in other words, come out of their drawdown positions. Sometimes it can happen a few times. They could come into it once, twice, a few times, and then expand higher, just so you know. Sometimes they can do that. But in other words, what they're doing is they're mitigating their position. They're closing out their negative trades. Their trades that are in drawdown. And then they will seek buy side liquidity, buy stops, the money above this level. So technically, if you're in a trade from down here, you want to be offloading some of your position when price gets to this level here. Why? Because you want to be offloading your buys to willing buyers or to willing participants who are willing to buy. They will gladly buy above this level. And so you technically have to offload your position. So when they are buying the orders, you need to be the counterparty to their opinion and offload your position to them. So just remember this, when you buy and then you close up here, you sell your order back. And like I said, for every single buyer, there must be a seller. With these willing buyers, there must be a seller. That's where you close off your position, sell your position back. You're being a counterparty to these people down here. And then what would happen? Price would then rally higher, as you can see, create a high, retrace back down to some kind of mitigation again before rallying higher. And they will continue to do that constantly until they are done rallying, and then they will switch it the other way. There'll be like a break of market structure. There'll be some kind of inefficiencies down here, and price, what would normally happen is price would then rally up, mitigate, and then we start again. We keep going. This time, when these lows were being protected, once one low gets violated here, then you're looking for these highs to be protected. Looking for these highs to be protected. There's going to be money on this side this time now for breakout sellers, and they run that, mitigate again, mitigate something here, and then they go again. You would have had to be in here from the very beginning to understand everything I just explained to you. And now just regarding a market where the market is consolidating, just so you guys know where the money is. The money is going to be up here, and the money is also going to be down here. The reason the market is going sideways, or the reason the market is consolidating, because they are accumulating orders. Just think about it. Whenever price gets up here, what do you think is happening? There's going to be sellers up here. There's going to be stop losses placed in this level. Same thing down here. Whenever the price gets down to this level, there's going to be stop losses down here, and people are going to be getting into buys. So constantly when price is touching this top and the bottom, you know, the top and the bottom, top and the bottom, price is accumulating orders. And you have to think about it. There's going to be a midway point where people are going to be believing that if price gets above this midway point, you know, we're going to be bullish, and when price gets beneath, we're going to be bearish. So in other words, price is just accumulating all kinds of orders, and normally what would happen generally is price would then expand lower, expand higher, take out both sides, and then go ahead and move in the direction it wants to move. Just like I said previously, there's going to be the breakout sellers, the breakout buyers. There's also going to be the people who are protecting the money on both sides, and there's also going to be retail looking to sell at these points and buy at these points. So here I'm going to give you guys an example of an uptrend. I'm going to bring up my arrow tool, boom, and I'm going to just go ahead and do it like this, boom. So you can see here is a low. As you can see, a low, we have a high, we have another low, we have another high, and we have another low. And so you can see right now, price is moving bullish. Price is moving bullish. We're breaking above these highs. You can see some kind of equal highs, as you can see down here. What this is basically is, it's a sell signal to retail concept traders. By the way, like I said, we are all retail. You most likely watching this video, you are a retail trader. The way we trade is different. You might trade with retail concepts. I trade with smart money and institutional concepts. There's a huge difference. This might be like a sell signal to retail traders. To us, this is more so a liquidity generation, money being generated. There's a liquidity pool up here. Retail traders would have seen this and put their stop loss around these levels here, these levels over here, and they would have been selling. They would have got a piece of the pie, but ultimately they would have been taken out. As you can see, price is taking out liquidity, and then they come back down to some kind of mitigation play. You see the down close candle here. This is where they would have been in drawdown, and we're going to touch on this a little bit more further down the line. You see these lows over here, these lows. Beneath these lows would have been money. Price runs beneath the money, taking out the liquidity, taking out the sell side liquidity, taking out all the sell stops, and then it rallies higher. When price dropped beneath this level, this was the big banks. This was the big banks selling before they buy. When they sold before they bought, these trades here that they sold are still in drawdown. Yes, it is an up candle. It does not matter. The high comes from this low. This is where they started selling from, and they sold it all the way down to this level down here. And so in other words, they are in drawdown. These trades are in a negative. And so what they do is after price expands, generally they will come down to this level, to the down close candle. As you can see, this whole thing come down to the down close candle, and then they will mitigate at this level. And let's just look at this. They stayed in this area for 3 days. They came again for a 4th day, and there was another 3 days they were roughly around in this area again. So in other words, there was about a whole 7 days of trading where they spent in this level, right, where they were mitigating their drawdown positions. And then what did they do? Like I said, there's going to be money up here. All the money that was generated above here, when price was dropping lower, creating lower lows and lower highs, these lower highs all had money above them. And what did we do? We traded up higher to run the money again. We've run that money on the top side, and now we're retracing again. We're retracing again, as you can see. And by the way, on the lower time frame, you might be able to refine this down close candle even more. But as you can see again, we've returned back down to these down close candles as again, where we are mitigating at this level. So now this is a bearish example. Price is making lower lows and lower highs, lower lows and lower highs, lower lows and lower highs. So in other words, this is a blatant bearish market. This is going to be a great example as well. So you can see price making lower lows and lower highs. So one more time, you know what's happening in this scenario. This is a bearish market. The big moves are going to be on the drop side. The shorter moves are going to be when you are buying a market, these short moves. And just to give you an example, from this high to this low, we're roughly talking about 670 pips, which is huge pips, by the way, massive pips, a massive amount of pips. And then the retracement is roughly about 400 pips, which again is another massive play. So in other words, we know that GBP USD can push down 600, 700 pips, and it can retrace roughly about 400 pips. You know, you'll be looking at 400 pips. When price doesn't run out these highs are being protected, the liquidity above those highs are being protected, and technically you want to be bearish. And so when price runs out these lows, like I said, they're running out that liquidity on the bottom side. You know who's going to be selling from down there? Once again, there's going to be breakout sellers, there's going to be people looking to protect their money, and there's also going to be retail looking to buy. Every single time price creates a higher low, and so on along this way, on whichever time frame lower than this you're looking at, it's just more liquidity being generated on the bottom side to be run later. So the reason they retrace from this level, they normally retrace to mitigate something and then to run that liquidity that's resting beneath it. I don't need to go into much detail because you can see it, and it's just the opposite of what I just said about the bullish market. Price is retracing and then dropping more. Price is retracing and then dropping again. And then once again, price is retracing and is most likely going to drop again. The only way market price, there will be like a shift in market structure, is if price gets to this level, doesn't beat the low, and then trades higher. than this high over here. Then there's going to be a break in market structure after retracement should continue to rise. Now, family, this is an example of a market that was consolidating. So let me quickly zoom in on this one. This is Euro USD. And as you can see here, I'm not really looking at what's happening over here right now. You can actually see prices making a push for the liquidity beneath here, but that's not what I'm talking about right now. So what is happening over here? Price is moving sideways. Orders being accumulated on both sides. There's money on the top side and there's also money on the bottom side. There's liquidity up here. And just imagine if you had traded this. I was telling my mentees, look, if you're trading Euro USD at this time, you're probably crazy. Oh, Lord have mercy. I don't know what is going on here. So you can say, in other words, prices going sideways. This is a market condition that generally you want to avoid until you get some good study on how to trade a market that's moving sideways, how to trade a market that is consolidating. It gets to this high, it drops to the low. You jump in for the buy, you think it's going to push up higher, it doesn't, it comes down to stop you out. Then you think, okay, cool, this could be a sell. You're looking to sell, doesn't run out the low. As you can see, then it comes out to stop you out at these levels here. And if it wasn't stopped out the first and the second time, it would have done it now. This is a market that is consolidating. Generally, they will accumulate orders on both sides and there will normally be an expansion of the range and just a big push to run all kinds of liquidity, top and bottom. And this is exactly what it's done. The liquidity that was resting beneath here, they're running it out. It looks like they want to run out this one too. And for those people saying, oh yeah, man, they would have survived. Let's just say you jumped in from this very high. Let's just say you even got a sniper entry from here. You wouldn't have had a 100 pip stop loss. If you are trading with a 100 pip stop loss, you're playing yourself.